Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Bessent's economic D-Day. The Treasury Secretary tells anyone doing business with Iran to cut ties or face sanctions, putting the US on a collision course with China. The chip sell-off extends as investors count down to tomorrow's earnings from Nvidia, but Bitcoin's rally rolls on, climbing above $80,000 a token for the first time since May. And Volkswagen CEO prepares to face workers as he makes the case for as many as 100,000 job cuts at the German car maker. Well, a very good morning. Here's how markets are shaping up this Tuesday. That transatlantic tech sell-off that we saw yesterday hitting Asian stocks this morning. The MSCI Asia Pacific Index flat to the downside, but Korean chip makers leading the losses after we saw Nvidia posting its longest losing streak since 2022 in the countdown to its earnings tomorrow. Futures now pointing cautiously higher on both sides of the Atlantic, but flip the board cross-asset. We do have oil a touch lower this morning, adding to yesterday's losses after US Treasury Secretary Scott Bessent threatened economic asphyxiation for Iran. Treasury's also pretty steady, the 10-year there at 471, having dropped 4 basis points yesterday. Goldman and Wells Fargo strategists saying that Bessent's buybacks will not do much to reverse the jump in long-term yields. Just finally, we've thrown in Bitcoin this morning because it has passed that 80k a token mark for the first time since May, up for a third day now, but still well below that 126k peak. The OG cryptocurrency back in vogue as that chatter about the debasement trade has been reignited by Bessent's buyback plans. Does momentum build now that it has crossed this psychological threshold of 80k? We'll keep an eye. Now, let's take a look at some of the risk events on the agenda for today. At 7 a.m. London time, top of the hour, we'll get a final read on German GDP. We'll also, at 9 a.m., get the closely watched German IFO survey for August. A bit more important, this, it should give us some clues on to whether the economy can sustain its momentum into the second half of the year. And then at 3 p.m. London time, it's US consumer confidence data, expected to have slipped in August amid all the renewed concerns about the jobs market and inflation. Busy day ahead. Let's get started. We begin with tech stocks underperforming in the Asian session this morning. Let's get straight to Winnie Hong in Hong Kong for an update. Winnie, what are you watching?
Yeah, good morning, Lizzie. Well, we are seeing Asian stocks fluctuating quite a bit today. It seems like investors still mainly staying on the sidelines and perhaps a bit of this calm before the storm, if I may say. We are watching out for quite a few risk factors. We have Iran sanctions and also the trade tensions between the U.S. and Canada, as well as the U.S. and China, plus global yield environment still looking elevated and a bit of uncertainty around that front. Now, of course, investors trimming some exposure ahead of those two big events. You have Nvidia earnings and that Jackson Hole meeting. So right now we are seeing MSCI Asia around trading flat, but the loss is being driven by the tech gauge, while we are seeing a bit more bright spot when it comes to financials as investors rotate away from tech and into some of the more defensive sectors. And leading losses today, we also have tech stocks in Hong Kong around its lowest level in about 7 weeks. Now that is being dragged down by a series of weak earnings and also a bit of a market liquidity drain from the recent IPOs that we are hearing and seeing. Now, flip the board and take a closer look at the tech stocks performance, because leading losses today, we have chip makers including Samsung Electronics and SK Hynix tracking those losses from the US peers overnight. You just mentioned Nvidia losing for 7 days already ahead of its earnings. Of course, it's all about the sustainability of the AI demand, but still some concerns around the circular financing that we are seeing in the company. Now, another big drag, though, is in the EV maker XPeng, which is down about 10% in Hong Kong, following those disappointing earnings from the second quarter, as well as third quarter outlook also missing estimates. Back to you, Lizzie.
Winnie Sue in Hong Kong, thank you very much for the update. Well, let's turn now to the latest from Scott Bessent, the US Treasury Secretary threatening economic punishment against any country doing business with Iran as part of what he called an economic D-Day campaign to end nearly 6 months of war.
Today, we are launching Operation Economic Outcast to foreclose every other option available to the Iranian regime. Treasury has mapped every node, every facilitator, and every network that Iran has used to smuggle oil and evade sanctions. Beginning today, the actions of Treasury and other agencies will tighten the noose and block every potential source of revenue that funds the IRGC and the evil Iranian regime.
Let's bring in Bloomberg Horizons Middle East and Africa anchor Abir Abu Omar for more. So it was a bit light on detail, wasn't it? No timeline, no specificity when it comes to what the punishments will be. What do we actually know about the steps the US is taking?
Not much, Lizzie. And as a matter of fact, probably that press conference that Scott Bessent was speaking at probably left some questions or more questions unanswered. Now, no timelines, no specific details, but also no specific countries. Now, before this, of course, we were discussing what countries would be prone to those secondary sanctions, because we had a lot of reason to believe that the announcement was going to be about secondary sanctions. Now, Scott Bessent said what the plan will look like and how many countries will suffer if they continue to do trade and financial transactions with Iran. But he fell short of saying just what exactly are those countries. He did not specify China, of course, when asked about it. But again, we have a lot of reason to believe that it would be China that would be set to suffer the most if the U.S. were to go through and implement those sanctions or those secondary sanctions. Now, of course, we reported at the start of the war that the U.S. had sanctioned some Chinese independent refineries, for example. But it did not sanction any financial institutions that did facilitate trades between China and Iran. Now, of course, we also know that China buys about 90% of Iranian oil exports. Those, of course, are halted for the time being because of that U.S. naval blockade. But China's response has really been a return to diplomacy. It's always maintained that sanctions will not be effective. And then again, the big question here is, how will those sanctions be implemented? Will they actually be implemented against China, especially with that pending Xi Jinping visit to the United States next month? We just have a lot of unclarity, Lizzie, and this is definitely what you're seeing reflected in the energy markets. Brent crude price is not really doing much in response to that Scott Bessent press conference.
And I suppose when it comes to the Iran reaction, a bit. I mean, Iran's weathered decades of US sanctions already. So is this going to be enough to make Tehran capitulate, I suppose, is the big question. How has Tehran responded?
That's a good question, Lizzie. Iran has multiple times before even the announcement of this said that it's ready to take on those economic pressures, that it will not capitulate because of these economic pressures. The economy minister in Iran did say in a press conference as well that Iran is fully prepared to take on these economic pressures by the United States, and it has a time of about 2 years to take on this isolation plan that was laid out by Scott Bessent. And then at the heart of all of this, which is really important, of course, is we don't know if Iran is going to let up any kind of dominance over the Strait of Hormuz, right? Because when it comes to the economic pressure that the U.S. hopes will have Iran succumb, maybe it'll take 6 months, maybe it'll take 2 years. We just don't know how Iran will retaliate against that economic pressure. And then it'll take multiple months, if not years, in the claims of Iran. But then how will that help what is happening in the Strait of Hormuz, or what is not happening in the Strait of Hormuz? That lack of movement is still very much there, and ships and vessels are still very much prone to the threat of being attacked by either the Iranian side or the U.S. side. And so that doesn't solve the problem in the Strait of Hormuz. Of course, we have no clarity over that deal between Oman and Iran to open up a pathway in the waterway. That was discussed multiple times over the past 2 weeks, but there's just no light shed on that conversation. Right now, we're focused on what Scott Bessent had said. And in Iran's case, or in Iran's response, what they said was they're ready to take on that pressure, and it's really not going to affect it. And as you said, 50 years or so, 47 years of those sanctions. Iran is, of course, one of the most sanctioned countries in the world. And so more or less of the same is not really going to have an imminent impact.
OK, and we're going to dive into the latest at the Strait of Hormuz later on in the show. But for now, Bloomberg Horizon's Middle East and Africa anchor, Abu Omar. Thank you. Well, US Treasury Secretary Scott Bessent's threat to unleash an economic D-Day against Iran risks setting the US, as Abir says, on a collision course with China, Iran's main trading partner. Meanwhile, we're told that the US is set to impose a 7.5% tariff on Chinese goods over allegations of excess manufacturing capacity. Let's tie those two threads together now. We can bring in Ros Matheson, our chief Asia correspondent. So, Ros, how could this all hit US-China relations ahead, of course, of that key Trump-Xi meeting next month?
Well, that's the big question, but these measures sound significant potentially again if the US does ever follow through on these threats of secondary sanctions against Iran. They have, done that multiple times. They've threatened and not done anything. If they did, it would impact China significantly, which gives you the sense that they might want to pause that a bit because, again, neither side really wants to push through to a full-blown trade war again ahead of this planned summit between Xi Jinping and Donald Trump that's coming up just in a matter of weeks, potentially. And so what you've got are these measures that are pushing the other side, testing the boundaries with each other, but not really tipping it over. So, for example, this potential 7.5% tariff on China over capacity. What we understand is they might actually set that rate higher but suspend some of it in order to keep the total tariff rate on China below the threshold that China has said that it's comfortable with. So we're talking about 20% all up for China. So keeping it below that level that would trigger some kind of more forceful response from China. So again, they're taking these tit-for-tat actions against each other on trade at the moment, on tech, on other sectors in the run-up to this meeting, but not doing anything that might tip it over back into that full trade war. So a sense, at least, from both sides that they know where those boundaries are. That's why you might see the US still threatening these secondary sanctions on Iran, but so far no sign they're following through.
Well, speaking of tit-for-tat tariffs, we've had Trump also pledging to double down on Canadian auto tariffs starting next year, escalating that trade fight between those two economies. So we heard from the Canadian Prime Minister, Mark Carney, speaking about the trade negotiations at an event in Quebec yesterday. Let's just take a listen.
Goal of our trade negotiations with the United States has always been to get the best deal for Canadians, never a deal at any price or on any time frame. Well, we made progress, and we did make some progress in recent weeks. In the end, that momentum reversed, and we could not accept what the U.S. had offered, nor could we give what they asked.
So, Ros, what's next? What are we expecting from Canada in response to President Trump's autos tariffs?
Well, what we're expecting from Canada today, for a start, is a sense of what aid they're going to provide to their own economy, which would be hit by these tariffs, and particularly a sense it's geared towards smaller businesses, which so far have been largely shielded from some of the tariffs that have already occurred between the US and Canada. So what we're looking at is possibly aid for people who lose their jobs because of these tariff wall being rebuilt. Also, loans to small business, a bit reminiscent of what we saw during COVID, for example, COVID-era assistance to companies. So expecting a bit more detail from Canada on that. But also a sense, again, of like what exactly do they mean by dollar retaliation. It's interesting, Mark Carney started with that. Now he says it's a bit more complicated, again, to work out exactly how that retaliation is going to look like against the US. So we're still waiting for some more parameters around that. And within all of that, even with all the rhetoric, still a few voices on either side saying, is there a way for us to get back to the table and have talks? It does seem unlikely given the political climate in both countries right now, but there are those voices saying, we got close, there are parameters here, some understandings around a deal. Maybe, just maybe, we can find a way to get back and have those conversations.
Yeah, if January the 1st is the deadline, maybe there's a window between the midterms and that for an off-ramp for negotiations. She says hopefully. Ros, thank you very much. Bloomberg's Rosalind Matheson with the Asian perspective and the latest on Canadian tariffs as well there. Still ahead on Daybreak Europe, though, Volkswagen CEO Oliver Blume will be presenting his restructuring plan to workers today, which could wipe out as many as 100,000 jobs. So we'll get more on what to expect from that meeting. But first, Scott Bessent's bond buyback plan faces scepticism, with even his former mentor joining the list of critics. More on that next. This is Bloomberg.
We haven't bought a single bond yet. The next time we have an operation is September 9th.
US Treasury Secretary Scott Bessent there avoiding any new signals on how he's going to manage the bond market in his press conference yesterday. But those comments coming after CNBC reported that the Treasury Department could use its general account held at the Fed to fund buybacks of longer-dated bonds. Let's get more now with Ven Ram, cross-asset strategist at Bloomberg MLive. So, Ven, it seems like to facilitate his bond buying plans, Bessent could be using cash parked at the Fed or replacing one type of debt with another. Does either of those options seem like a feasible way to bring down long-term yields sustainably?
No, I don't think it's going to bring down long-term yields sustainably, and I don't think Bessent frankly expects them to. I think what his aim is to keep yields from rising further. I think that itself will be a big victory against the current backdrop where term premiums are rising. Now, the earlier buyback plan was that, was considered an Operation Twist, where they would issue short-term bills and fund the long-term buybacks. So, i.e., when you issue short-term bills, the private sector invests money into them, and that means a drain on liquidity. Whereas with the TGA, they pull out money from the Fed and put it into the economy. So it kind of is a liquidity infusing mechanism, and it also creates reserves mechanistically. So I think that it's going to help at the margin because it creates liquidity, as I said. But I don't think this is going to be the turning point for the markets, because this is more tinkering at the edges. What they need to do is they are trying to address the symptoms, which is the treasury yields. But what they really need to do here is to address the deficit. And unless they can address the deficit and take that head on, they can't make much progress here.
OK, but, I mean, even Bessent's old mentor, Stanley Druckenmiller's described the plan as a mistake. This was in a Wall Street Journal column. And then he's just one of a chorus of critical Wall Street voices. So, Ven, I mean, how much does it all undermine Bessent's credibility and the effectiveness of the plan? Do you see him changing course at all?
I don't see him changing course. Look, he's caught between a rock and a hard place. Scott Bessent, the investor, knows very well what exactly he is doing and that he's tinkering at the margin. But he, as a Treasury Secretary, he doesn't really have a choice. Yields are going up every single day, and he's got to stop the deluge. And what does he have to do? He doesn't have too many instruments at his disposal, and what he's doing amounts to what he can tinker with. But what he fundamentally needs to do, as I said, is to address the deficit, and that's not exactly something he has got too much wiggle room over. Of course, he can make suggestions, make proposals, reduce funding to states, look at fraud mechanisms and things like that. But that's not going to bring down the deficit by a whole lot. The deficit bill is already north of $1 trillion per year. So that needs to come down a whole lot for this to work, for the term premiums to compress. And unfortunately, all the questions are being thrown at him. He doesn't have the answers.
Hence why many analysts are saying that these higher yields are the new normal. Ven, thank you very much. Ven Ram there from our Bloomberg MLive team. Well, coming up on the programme, with the Strait of Hormuz still constrained, Gulf producers and global energy companies are accelerating structural efforts to bypass the waterway entirely. We'll get you our analysis next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:23 a.m. here in London. Well, let's dive back into the Middle East situation now, specifically how the closure of the Strait of Hormuz has exposed the risks of relying on one of the world's most important energy choke points. Despite disrupting roughly 20 million barrels of oil a day, the markets proved more resilient than many expected. A special report from Bloomberg Intelligence examines how the world adapted and whether the crisis marks a turning point for global supply chains. I'm joined now by Will Hares, Senior Energy Analyst here at Bloomberg Intelligence. Welcome, Will. So what's the current status of flows through Hormuz? Let's start there.
So the Strait of Hormuz is neither fully open nor fully closed at the moment. We've had recent reports from the U.S. government officials saying that up to 10 million barrels per day is flowing through the strait.
You trust them?
We are heavily skeptical of this data. It's not supported by publicly available vessel tracking data. But I think the key takeaway is that regardless, there's more oil flowing now through the strait than there has ever been before. And this underlines that there is some degree of success that U.S. naval support, military pressure, and convoy escorts through the southern corridor around Oman is having some success.
That's crazy. So it's not just that tankers are bribing Iranian officials, it's that the blockade, the escorts from the U.S. is actually working.
This appears to be the case, although we see roughly 5 million barrels a day, somewhere around there. The U.S. government has said 10 million barrels a day. It's worth noting that some of their messaging has been incredible at times during this. But regardless, there's more oil coming through the strait now than there has ever been, and there are incentives on the U.S. side to report that more oil is flowing.
Okay. I mean, that's a crazy kind of stat. So where does it leave the energy majors then? How are they dealing with the disruption?
So the energy majors have had a bumper 2Q. The European energy majors, Shell, BP, and Total, they are heavily operationally exposed to the Gulf. So they've taken a lot of production hits from LNG, from GTL, from upstream oil. However, three elements really helped offset that in 2Q. You have elevated price capture on oil and gas benchmarks. You have trading, and you also have really extraordinary refining margins as well as a result of this. So we saw very strong 2Q results, and we think that that probably eases a little bit into 3Q. But these are some of the best positioned companies with their large portfolios, diversified asset bases that can spread the pain around a little bit.
Yeah. So if we want to trade this and we're looking ahead, have we hit peak Hormuz disruption then?
So I would say no. We have not hit peak Hormuz disruption. I think there is a very easy case to see that there's more disruption ahead. In fact, we've heard Tehran in the last few days threaten not a single drop of oil will go through the strait. But peak Hormuz dependence, absolutely. We think 2026 will represent the zenith of the strategic and geopolitical dependency on the Strait of Hormuz as companies and countries de-risk, invest in bypass pipeline expansions, more storage, anything to reduce Iran's leverage in the future.
So very briefly then, surely that weakens Iran's hand geopolitically. This was its trump card.
So I would say that it still is Iran's strongest trump card. The weaponization of the Strait of Hormuz is essentially all that Iran has. You have the rial at its record low. You have 80% inflation in Iran. But the key point here is that it is the declining, deteriorating leverage. The strategic irony for Iran is that the weaponization of the Strait of Hormuz has incentivized everyone to de-risk from Hormuz.
It's really fascinating stuff. Will, thank you so much for bringing us that analysis. Will Hares, Senior Energy Analyst at Bloomberg Intelligence. Stay with us for more. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Bessent's economic D-Day. The Treasury Secretary tells anyone doing business with Iran to cut ties or face sanctions, putting the US on a collision course with China. Meanwhile, chip stocks in Asia rebound after early losses after investors counting down to tomorrow's earnings from Nvidia. Bitcoin's rally rolling on as well, climbing above 80k for the first time since May. And Volkswagen CEO prepares to face workers as he makes the case for as many as 100,000 job cuts at the German car maker. Well, a very good morning. 6:30 a.m. if you're just joining us. Welcome to the programme. This is the picture in markets, and we are actually seeing the MSCI Asia Pacific Index much higher than we did at the start of the programme. And it's actually Korea that's partly helping this. The Kospi are raising losses of as much as 4.3%. So now it's trading up 0.4%. And we've got futures pointing higher on both sides of the Atlantic as well. So a bit of enthusiasm to start this day now. Flipping over to the cross-asset picture, we've talked a lot about geopolitics on the show so far. Brent weaker by 0.2% at just shy of $92 a barrel now. Of course, we've had Scott Bessent threatening Iran's economic asphyxiation, but we're waiting for more details on what that will actually mean, both in terms of timeline and in terms of the punishment on those countries trading with Iran. So let's take a look as well at the bond market. The 10-year Treasury yield at 4.71, up a basis point as things stand. And a lot of debate, of course, about Bessent's buybacks. Goldman and Wells Fargo strategists saying that they're not going to do much to reverse the jump in long-term yields. And finally, I've mentioned Bitcoin still above that 80k mark, up for a third day. Really, the OG cryptocurrency back in vogue as we have to talk more and more about the debasement trade, that debate reignited by those buyback plans from the Treasury Secretary. Now let's take a look at the front pages this morning. We'll kick off with the Financial Times today. It's focusing on the impacts of the Iran war really being felt in America's Corn Belt. Farmers telling the newspaper that they're facing their worst crises in 40 years, ahead, of course, of the crucial US midterm elections. Flipping over to the Wall Street Journal next, and it leads on a wave of new US IPOs expected in the coming months, with Aura and Dunkin' the latest to prepare for listings. And finally, let's turn over to the UK. The Times this morning leading with comments from Prime Minister Andy Burnham, refusing to rule out taxes in this autumn's budget, but saying that he won't risk people's jobs or livelihoods. I wonder how he'll thread that needle. But you can get a roundup of all the stories you need to know to get your day going by looking at today's edition of Daybreak, which terminal subscribers can find by going to DAYB Go. Now, elevated borrowing costs and persistent inflation have pushed long-end yields to multi-year highs. This is around the world, but for the UK gilt market, the backdrop is even more complicated, specifically by mounting fiscal pressures ahead of Chancellor John Healey's first budget in the autumn. For more, I'm joined by Anna Macdonald, Investment Strategy Director over at Hargreaves Lansdown. Great to have you back, Anna. So someone tells me that your clients have been buying gilts across the curve. Why?
I think they are seeing that the yields that they can get are actually quite compelling. Even if inflation is above target, 2.6% at the last print, we do see that they are thinking that the real return that they can get is still quite compelling. And remember that for private investors, gilts are capital gains tax-free, so that adds another element. And we're seeing that they are buying, particularly from about 2035 out to 2055 at the moment, hoping to get that slightly higher risk, longer duration trade as well.
But of course, we're counting down to October the 28th, and as ever, before any budget, you've got all of this uncertainty, pre-budget speculation. It tends to hold back investment and spending. Even though you've got Healey promising to have Defence Department style security on leaks, how much volatility are you expecting between now and the end of October?
Well, if we take the last two budgets as an example, the run-up to the budget is filled with speculation, and that actually can lead to some quite unhelpful behaviour and unhelpful action. So we can see that amongst companies and businesses who defer spending decisions. And individually, that might make sense, but collectively, it often means that in the UK, we've seen first half economic growth really tempered by the second half. Now, when it comes to our clients on the platform, what we've seen is that fears around where those tax rises are going to fall. The Labour manifesto, which Burnham says he's sticking to, ruled out, as you know, increases to VAT, income tax, national insurance on employees. So the big three revenue raisers were ruled out. So people start looking at where could he get those tax rises? And the last two budgets, we saw substantial increases on the platform of people taking tax-free cash out of their personal pensions. And when I say substantial increases, it may be coincidental, but the months from January to the budget, the average we took from that in the month just prior to the budget, they were as much as 150 to 180% more. So we do see those kind of actions ahead of the budget as people worry about what's going to happen.
It's really interesting because it's not just that investors want the Chancellor to balance the books. They're specifically thinking about which tax levers are pulled.
Yeah.
I wonder if your kind of confidence in the Burnham team has been knocked a bit by the fact that Jim O'Neill doesn't want to be part of that team. There's speculation that it's because he didn't agree with the policies on tax that the Burnham government might employ, but he says it's just because he's got better jobs and he wants to do those instead. How do you view it?
Well, I think that we did take confidence that Jim O'Neill, Andy Haldane and Richard Hughes were all part of that team that were advising Burnham before he got to number 10. I think that Jim O'Neill is particularly against capital gains tax rises, and that is certainly and against wealth taxes. And we would concur with that. You know, anything that takes away that kind of level of certainty does tend to be detrimental to tax take overall, because it's detrimental to how confident businesses and people feel. Andy Haldane still seems to be quite close in the running, and I think that he has had interesting things to say about how tax-raising speculation can actually lead to make the problem worse. It makes investors more nervous. It makes them demand more return on their borrowing, on their lending. So it can actually have that effect of making the situation worse.
Yeah, we should remind viewers that, of course, Haldane was formerly the chief economist at the Bank of England. I also just look at the data and, you know, it's been pretty kind to Burnham. The PMIs, the latest GfK confidence survey. Is your read that actually Burnham's upbeat rhetoric is going to translate into better investment, better spending, in contrast to what we saw at the start of the Starmer administration?
I think he started better. He started on a more positive note. I think that a lot of commentators would say that Starmer and Reeves, their first actions actually were to say, gosh, things are in a terrible state.
It was gloomy.
It was gloomy. Let's take away the winter fuel allowance. Let's do things like that. But now I think that, yes, he's come in, the vibes, as you'd call it, have been quite positive, but it's still... He still faces those same fiscal constraints, and arguably they've got a bit harder, and Healy's job with the rise in global bond yields has also made things even more difficult coming up to the budget.
Just finally, I wonder how your clients are feeling about the wave of UK M&A. Yeah. Maybe this is something that could come up in the budget. It's not something we've heard too much about from Healy so far, but is it healthy in your view that you've got all of these British assets being hoovered up by foreign companies?
It doesn't feel healthy. We've had M&A since 2023 totalling 165 billion. We've had relistings in other markets of 120 billion. And yet we've only had new IPOs of about 10 billion. So it's not a healthy environment. I think one of the aspects could be stamp duty, and perhaps in any other budget we would see stamp duty on shares be taken away. It's a revenue raiser of around 3 billion, but lots of analysis shows that actually if you were to take it away, revenues would increase elsewhere. I think it would be a great thing to see that taken away, but because we're not a level playing field. Other countries do not charge anywhere close to this or any transaction tax. So that would be great. I think when you look down the queue of things that might happen, it may not be top of the pile, but it's certainly something that our clients would like, because they certainly over-index against most investor bases or most funds and most pension funds, for example, when it comes to how much UK equities they own. They are big buyers of UK equities.
Well, Chancellor, if you're listening, there's a tip for you, straight from Anna Macdonald, Investment Strategy Director at Hargreaves Lansdown. Thank you very much for joining us this morning.
Thank you, Lizzie.
Now, let's take a look at some of the other top stories we're following for you this morning. The UK Prime Minister Andy Burnham says that he and other European leaders plan to travel to the US next month to lobby President Trump on Ukraine. Burnham's comments came as he visited Kyiv on his first international trip since taking office. He told Bloomberg that European leaders are considering a meeting around the UN General Assembly in New York with a view towards securing US Patriot missiles ahead of Ukraine's winter. Elsewhere, the Trump administration has launched a new proposal to charge companies roughly $103,000 for each candidate they sponsor under the H-1B visa scheme. It follows a decision by a federal court to strike down its previous plan back in June. Critics say the fee is so onerous it would effectively shut down the H-1B pipeline for foreign-born professionals. And the US SEC is said to have sent subpoenas to major Wall Street banks over the hedge fund's situational awareness. Sources say it's seeking information about trading activity at the hedge fund, which came under pressure last month. Well, coming up on Daybreak Europe, Volkswagen CEO will present his restructuring plan to workers today, which could wipe out as many as 100,000 jobs. So we'll get you more on what to expect from the meeting next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Coming up to 6:45 a.m. here in London. Well, the Volkswagen CEO, Oliver Blume, will be presenting his restructuring plan to workers today at the company's giant Wolfsburg factory. The proposals could wipe out as many as 100,000 jobs. So let's get more now with Will Wilkes, our automotives reporter out of Frankfurt. Will, what exactly is Oliver Blume trying to achieve with this restructuring? And why is the pressure on Volkswagen so intense right now? Just remind us.
Good morning, Lizzie. Blume's argument is that Volkswagen has simply become too big, too expensive and too complicated for the world it now operates in. The group says its costs are around 30% higher than some key competitors. It has more than 500,000 vehicles of excess capacity, and profits are nowhere near where management says they need to be to fund the next generation of cars and technology. The pressure's coming in several directions. Volkswagen's lost ground in China. Chinese competitors are aggressively moving into Europe, and US tariffs are obviously hurting quite badly too. So Blume has told employees that the situation is more than critical. Obviously, employees say it's not quite that bad, and he's pushing to increase profits.
And as you'd expect, they're angry. So how much power does Labour have to block Blume's plans then, Will?
Well, yeah, crucially, Labour is not powerless in this situation. As per German corporate law, employee representatives hold half the seats on the supervisory board, so they are able to veto major or they are able to have a powerful voting bloc against major strategic decisions. Also, in the case of Volkswagen, the state of Lower Saxony holds a deciding balance, and they don't want to see factories close in their home state, so they tend to side with workers. So Blume has to somehow convince them he can't outvote them. The Volkswagen capital side can't outvote Labour and Lower Saxony at supervisory board level, so they're going to have to try and find an agreement and come together to find something that enables them to move forward.
OK, so for anyone monitoring the stock today, what should we be watching out for in terms of the meetings? Could they determine whether Blume can get his plan through Volkswagen's supervisory board next month?
I think, yeah, for anyone watching, you're looking for signs that Blume can try and rebuild some of the political support he needs with workers and Lower Saxony to try and build consensus for the package. What I'd watch for very closely is whether Blume gives employees anything genuinely new, particularly on jobs and the future of some of the plants in question. Labour has been demanding a lot more detail, and it's refusing plant closures and deeper job cuts. The bigger deadline comes on September the 4th when the supervisory board meets again. Bloomer failed to secure backing last time. So this meeting really matters. He needs to reduce the confrontation with workers and persuade Labour and Lower Saxony that Volkswagen needs a deeper restructuring.
OK, so an absolutely critical juncture. Will, thank you so much for setting us up for it. That's Bloomberg's William Wilkes. Thank you very much. Now, turning to the UK, and a property company owned by Britain's richest aristocrat is warning that rising temperatures and planning regulations are threatening the appeal of its properties in London's Mayfair and Belgravia. The Grosvenor Group wants the government to relax planning requirements to allow for basic cooling features. Joining us now for more is Olivia Rudgard, our climate reporter. Olivia, I feel like you're going to be touching on a sore spot with a lot of viewers who've been suffering in the heat this summer. What's stopping older properties in the UK from installing these features that keep residents cool? It's got to be a good thing, hasn't it?
Yeah, and actually some of these features are, they look quite traditional, they look quite aesthetic, so we're thinking about things like shutters and shading, and that's really what the Grosvenor Group wants to prioritise in its buildings. Really what's happening is that, as well as costs, there are also some quite stringent planning requirements, so especially if you're in an older or a heritage building in London, it might be listed, which means it's actually a criminal offence to do something without permission to that building, or it might be in a conservation area, which means it's a lower level of restriction, but you still have quite a restricted amount that you can do to the facade. And actually, even people in more ordinary buildings, if you own a flat, for example, can be restricted from doing anything to the facade by a freeholder. So there have been a lot of situations where people have gone to try and install an air conditioner or shutters or shading and found that they're banned from doing so. So
do you think that, as our other reporters tell us, this is becoming the new normal, there's going to be an impact on property prices in London?
I mean, I think that is the concern, and that is what Grosvenor is really saying, that, if we're not allowed to update our buildings, commensurate with the climate, then they're going to become less valuable. I think the other issue that we're seeing a lot more of in the sort of immediate term is subsidence. So this is where the ground, a lot of London is built on clay, and the ground really it swells and shrinks when you have periods of drought and extreme rain. And that means the properties move, and you get big cracks. You get really big insurance claims, and we've actually had a record quarter for those claims in the last quarter. So that's another real threat that I think you will start to see affecting the values of those properties.
Wow, so a weather story becomes a property story and an insurance story as well. Olivia, thanks for bringing it to us. Olivia Rudgard there, our climate reporter. Now to some other top stories that we're following for you this morning. Aggreko has filed for a US IPO after turning profitable as revenue increased. The power equipment rental company is the latest UK-based firm to look to US markets for its debut in a listing that could value it at about $15 billion. Elsewhere, Bloomberg has learned that Siemens Energy is working with Goldman Sachs as it looks to garner offers for its major stake in its steam turbine division. We're told the business could be valued at more than €10 billion, with CVC, EQT and Bain among the firms considering bids. And UK Prime Minister Andy Burnham has reportedly halted plans to put Thames Water into administration because of concerns over the cost and the legal risk. This is according to The Times. The government is said to be assessing whether there's a viable option for a special administration regime, a process the newspaper says could take several months. And Saudi Arabia is planning to build a theme park complex near Paris, an investment expected to amount to $7 billion over several years. The deal was personally kick-started by French President Emmanuel Macron and the Saudi Crown Prince Mohammed bin Salman. The park will include at least one area dedicated to Japanese manga, which a French official told Bloomberg the two leaders have a shared passion for. Who knew? Well, plenty more coming up on Bloomberg. We'll bring you some terminal charts to frame your day ahead. Stay with us. Good morning from London. This is Bloomberg.
This week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Just coming up to 6:55 a.m. here in London. And I want to bring you some terminal charts to frame your day ahead, because we started the show off by talking about those new higher tariffs that the US and Canada had slapped on each other. But did you know that the US imports more from Canada than from China? Canada taking the lead earlier on this year. And there's a Treasury angle everywhere, isn't there? Just flip the board, because also Canada happens to be the fifth biggest holder of US Treasuries. Again, catching up, closing the gap with Canada. A little fact that I'm sure hasn't escaped the attention of ex-central banker Mark Carney, which is awkward, isn't it, given the fact that we've had Wall Street in backlash against Scott Bessent's buyback plans for Treasuries. High-frequency economics, for example, saying that the Fed's independence is that Bessent is trying to usurp it. So all of that criticism coming out of Wall Street, including from one of Bessent's former mentors. And that takes me to the Fed. So flip the board one more time, because as we head into Jackson Hole, let's just take a look at where Fed hike bets are standing. For the first time in about 2 weeks, September rate hike bets back above 40%, as you can see in the white line. And for December, we're at 43%. So up again for both of those. We'll see how Chairman Walsh's speech at Jackson Hole on Friday changes this picture. But to access, search and save all of the Bloomberg terminal charts that we've used throughout this show and all the other shows on Bloomberg TV, terminal subscribers can use the function CHRT TV Go. Now, let's remind ourselves of the risk events on the docket for today. We've got German GDP numbers. These are the final numbers, but they're coming at the top of the hour. We've also at 9 a.m. got the German IFO survey data, so more of a read on the sentiment within the German economy there. Clues as to whether it can sustain its momentum into the second half of the year. And then later on this afternoon, 3 p.m. London time, we'll get US consumer confidence figures, expected to have slipped in August because of all the renewed concerns about inflation and the jobs market. So plenty on the docket for the day ahead. The opening trade is coming up next. Anna Edwards and Tom McKenzie will be taking you all the way to the start of the European cash trade. But that does it for Daybreak Europe. Good morning from London. Have a great day. This is Bloomberg.